New York is sounding the alarm. A crisis has begun, and the worst is still ahead. I'm Steve Van Metre. What just unfolded in New York will stun the world, soon sweeping across the nation and bringing fear to every American home. Now, let's head over to Bloomberg, where we picked today's story up with the headline, as New York manufacturing activity contracts for a third month. And what we're seeing signs now is the continued impact of the trade war on U.S. manufacturers. And one of the problems, as manufacturing slows down and continues to contract, it will pull the services sector down with a lag. And what this is causing is a lot of panic by consumers. It's something businesses have been warning about, but the unexpected is about to unfold, something nobody has predicted, and what it's going to do is bring terror and fear to every American home. The Federal Reserve Bank of New York's General Business Conditions Index fell 1.1 points to minus 9.2. Readings below zero are indicating a contraction, suggesting for the third straight month, we're seeing a contraction in manufacturing activity in New York. This is something likely to spread all across the country, and it's going to get worse because what we're seeing are continued signs of the impact of the trade war on manufacturers who have been front-running all of this demand and now are going to start to enter a period, what we call payback period, or an air pocket, where we should see new orders collapse and demand collapse, meaning this is only going to get worse in the months to come. An index of current prices paid for materials increased more than 8 points to 59. Manufacturers' expectations for prices also climbed. So what we're seeing again from manufacturers is not only is overall demand going down, but price pressure is continuing to rise. And this is causing a lot of panic for consumers because at the same time they're expecting prices to rise. The problem is they're seeing their hours get cut, their paychecks relative to inflation are shrinking. And this is just only one of the reasons that we're going to see a lot of fear in American households in the months to come. At the same time, a gauge of prices received and the outlook for prices charged both decline, suggesting profit margins risk being squeezed. And this isn't just about profit margins, although that's a factor here because a lot of businesses really want to see their profit margins expand. They want to see their stock price go up. But the real issue here is we continue to see consumers rejecting higher prices. We've said this is a problem because their paychecks aren't keeping pace. This is the big warning sign that manufacturers are telling us, look, we're trying to raise prices, our costs are going up, our margins are getting squeezed, and yet we cannot pass that on to consumers. Let's take a look at the data here out of New York, and why we can see what's going on is a devastating impact to their manufacturing sector. As we look at current prices paid in blue against current prices received in red, and you can notice a general relationship to the two, but one of the key things I want you to see here is the current prices received, and that's shown in red because despite the fact that we go back to 2011, what do we see? Businesses are raising prices, but consumers are rejecting them. What happens? Prices received fall, and next thing you know, what happens? Prices paid come down. So what we see here is this belief that prices are only going to continue to go up, and we hear this from consumers, we hear this from the Fed, we're hearing this from businesses, that yes, prices are only going to go higher, but the reality is, due to a massive inventory overhang and shrinking paychecks, what's going to happen is demand's going to go down, and that means prices are going to continue to fall. And we've got a lot of evidence as we move forward to 2015. What do we find out? Prices received going down, and that means prices paid follow. You see that happen in 2017. We see that happen in 2018 throughout 2019. You can notice very clearly right here, prices paid are going higher, but they can't pass it on to consumers. We see that in late 2021 going into 2022. Prices paid are on the rise. Consumers, again, rejecting them. We see prices received fall, prices paid follows, and now we're seeing the same effect. So just despite the fact that businesses are telling us that prices are going to go up, what consumers are telling us is the real direction for prices is likely to come down. Now, this means, of course, profit margins are going to be squeezed, and the evidence of that is also very clear when we overlay corporate profits after tax in green, and we can see there's periods like 2006 through 2008 where prices paid are rising, but those costs aren't passed on to consumers. What happens? Corporate profits after tax are getting squeezed, and you can see inner contraction, and we could see that relationship happening over and over again. So one of the big fears for households is going to be the fact that profits aren't going to go up. And what we've noticed is a lot of investors are over allocated to U.S. equities. And what this is suggesting is that profits roll over and head lower, well, is a big risk for the equity market, and that's what we're facing here after 2022. There's that pullback in the market, profits took off, stocks took off, and now what we're hearing from the business sector is, look, we're going to head back into a contraction, and that's a dangerous sign for equity prices and for the net worth of a lot of Americans. The manufacturing sector has struggled amid rising input prices and uncertainty from Trump's whipsawing trade policies as companies adjust their imports and supply chains. But it's not about rising prices. So this is the issue that everyone's focused on, is that prices are going to go higher. This is a problem for businesses, but it wouldn't be a problem if they could pass it on to consumers. But something we talked about in yesterday's show, what are a lot of businesses doing? Well, they're not giving out big pay raises anymore. They're cutting hours. So the problem is businesses are very well aware that they're raising prices and their own employees are not keeping pace. So the expectation here is rising prices are a problem. No, the real problem is paychecks, and they're shrinking. And let's take a look at what this means for consumer prices, because when we see demand goes down, well, it means that consumer prices are soon to follow. And I want you to see here as we overlay the consumer price index in green against current prices paid in blue and current prices received in red for New York, what you can see is a strong relationship that the consumer price index has with prices received. So right now, this is the big shock that everybody is not prepared for, is that prices paid are skyrocketing. They're heading higher. And businesses are saying, look, we're going to keep raising prices. And again, this is causing panic for consumers. But what it's leading to is a decline in demand. And based on history, what this means is a consumer price index, which actually ticked a little bit lower despite the fact that prices paid jumped. What it means is we're going to see further disinflation here. At the same time, what is the Fed doing? They're sitting on their hands. They're uncertain. They don't know how to respond to this. But if consumers are responding by saying, look, we couldn't afford prices where they're at, we certainly can't afford them where they're going. And that means, my friends, the big shocker to the world is prices are coming down. But at the same time, it also is a big risk for the equity market. And if that's not enough, what you're about to see is going to impact the labor market in a major way. The New York Fed report showed demand is holding up, but not for much longer based on what we're seeing from consumers, with a gauge of current new orders and an index of shipments both expanding, but that's likely due to the ongoing trade wars. Again, people still trying to front run any changes to it. But still, a measure of supply availability shrank at the fastest pace since mid-2022, but something should be expanding at the fastest pace since 2022. Well, that's your trading account, because it is for our Momentum Timer Pro subscribers. While everyone was chasing the large cap hires, we told them to buy into BITQ at the end of April, and as of yesterday, we were stopped out for a nice 18.89% gain, and that was just one of the many big trades that our subscribers got stopped out of. Now, if you want to trade momentum like a pro and make big returns, grab the links in the description below, use a coupon code for your free 30-day trial, and stay tuned to the end of the show for more information. Because when we look at the relationship between new orders and consumer prices, what it's telling us very clearly is this move higher in new orders is going to get reversed in a major way. And again, one of the pain points that's going to hit American households is not only the fear of inflation that's going to go the other direction, but also the risk that the stock market could go down. It's all about the labor market, because when new orders go away and there aren't enough backlogs to keep workers in place, the unemployment rate goes higher. And that's exactly what the consumer price index is telling us, because we can go back to 2002 and we can run this all the way up into 2006. And what do we find? Consumer prices were on the rise and new order demand was up. But what happened after? Well, we headed into a recession, and this is a little bit unusual because energy prices sent consumer prices higher at the same time, because energy prices were pulling more money out of the discretionary budget of households. What we found out is new orders came crashing down. But aside from that, you can see the very strong relationship where consumer prices go, the new order book follows. And right now, the consumer price index is telling us that the likely direction for new orders is to the downside. And again, this is about to hit the labor market. In fact, New York is saying it already is. The index for the number of employees came in at minus 5.1, and the average work week index was minus 3.4, pointing to a small decline in both employment and hours worked. So what we saw from New York manufacturers as they look forward at their demand and their new order book and their backlogs, they don't need all the employees they have. So what they do, they started cutting employees and cutting hours. And we know in the months to come, as this gets worse and inventories get bigger, we're going to see more and more Americans hit the unemployment line. and then with a lag, it's going to impact the services sector, and the next thing you know, the odds of it going into a recession get very high. And here's the evidence as we take a look at the current new order book for New York in blue against the unemployment rate in red. And what do we see? As new orders go down, well, the demand for workers goes down as well. You see the unemployment rate go up. You see it happen here between 2006 and 2008. And now we're facing the same thing. Despite the fact that there was this brief expansion of new orders, it really didn't have much impact on the labor market. Had a little bit, but not much. Now what the consumer price index is telling us that the path for new orders is down, and that means the direction for the unemployment rate is higher, and that again puts us at a very high risk of going into recession sometime this year. And consumers are panicking as they note that now sentiment falls close to a record low. The media wants you to believe it's on inflation, but it's not inflation. It's about paychecks. It's about finances. Because if inflation goes up and paychecks are rising fast enough, it's not an issue. The real issue here is just what New York is telling us. They're cutting jobs. They're cutting hours. And if new orders go down, there's going to be a whole lot more cuts. And the problem is workers already know it. The preliminary May sentiment index climbed to 50.8 from 52.2 a month earlier. That was lower than all but one estimate, meaning everybody is more optimistic about the economy than consumers actually are. And this is one of those baffling things that all these experts keep telling us how great things are, but the real economy is in far worse shape, and consumers are telling us very clearly that not only is the outlook for their finances going down and the labor market going down, but if they lose their job, their outlook to get another one is getting bleaker by the day. Nearly 3/4 of respondents spontaneously mentioned tariffs, indicating trade policy continues to dominate consumers' view of the economy. The topic crosses partisan lines, including a notable share of Republicans bringing it up. And what this means is we are going to see this trade war get wrapped up a lot faster than many people expected. When we talked about this months ago, many people said we're in it to win it. We're going to go through all the pain it takes. But now the pain is starting to set in, and you're going to see policymakers reverse course and fast. President Donald Trump said he would set tariff rates for U.S. trading partners, quote, over the next 2 to 3 weeks, saying his administration lacks the capacity to negotiate deals with all of his trading partners. He said on Friday the Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick will be sending out letters essentially telling people what they'll be paying to do business with the United States. So what you can see is panic at the top. The political elites are listening. They're seeing demand go down. They're seeing consumer confidence get crushed. And what they realize is this trade war needs to come to an end and fast. But one of the risks that I think, one of the things I'm really worried about is the damage to the economy may already be done. It may be too late, but I want to know what you think. Is the turnaround of the trade war going to be a turnaround for our economy, or is it too little, too late? Weigh in the comments below. Love to hear from you. Because consumers expect prices to rise at an annual rate of 7.3% over the next year, the highest since 1981. And yet at the same time, when we look at the relationship between prices paid and prices received in New York, what does it tell us? That that's the unlikely path. And that's a real shock because many people are not going to believe that price pressure could actually abate. We could see further disinflation, but it has everything to do with demand and incomes. Because if incomes aren't rising, demand goes down, inventory overhangs get crushed, and next thing you know, disinflation and maybe even deflation eventually show up. They saw costs rising at an annual rate of 4.6% over the next 5 to 10 years, the highest since 1991. But the real issue is all about paychecks as we now take a look at the University of Michigan Consumer Sentiment Survey. Now keep in mind the data we're looking at is preliminary. The chart shows the actual data against the average weekly hours of production of non-supervisory employees. That's shown in red, and you can see the relationship between consumer confidence and paychecks. It's very tight. And what consumers are telling us very clearly is they see that their hours are going to get cut, and that's why their confidence is plunging. And we can see that going into every recession throughout the cycles. In this recent cycle, what did we see? A continued downturn in hours worked, but consumers got confident because the stock market went up, and now they're realizing the stock market isn't the real economy, and perhaps the bigger risk is the stock market could go down at the same time. They could face losing their job and not being able to find another one. The survey showed the expectations index looking out a future of 6 months declined nearly a point to 46.5, almost a 45-year low. The current conditions gauge retreated 2.2 points to 57.6. So what consumers are telling us, look, they're going to tighten their belt because they think the outlook isn't a short-term problem. They think it's going to be 6 months or more, and that means you're going to see consumers spending even less. And yet, as we look back now, what happened? Going into the tariffs, there was this massive front running. It led to a massive buildup in inventory, and now businesses are facing getting squeezed at a margin. At the same time, they have way too much inventory. Look, an inventory recession was never in the cards, and now all of a sudden it's going to be added to the deck. It's a very dangerous situation. It's going to leave the world shocked when this all hits. Consumers' view of their current personal finances dropped to the lowest since 2009. There's a global financial crisis. Financial expectations slid to a fresh record low. So what consumers are telling us, not only is this a short-term issue, it's a long-term issue. That means they're tightening their belts. They're going to spend less, and of course, they're going to save more. When that happens, it's going to impact and ripple all across the economy. The notion that we're going to continue to see prices paid go up and drive consumer prices higher, not going to happen because demand is going to plunge. And that means the unemployment rate set to go higher as we take a look now at the University of Michigan Consumer Sentiment Survey, overlaid with the unemployment rate in red. And you can see consumers are sounding the alarm here. When their confidence goes down, it's about their finances and their spending. And that means job losses are about to head higher. Keep in mind, this is the same time the Fed's doing nothing because they have no clue what's coming for the economy. But we can see very clearly in every past cycle, confidence goes down, the unemployment rate goes up, and now we're facing the next stage. This could hit in the next month or two. I want to know what you think based on your job. Do you see the unemployment rate starting to skyrocket, or do you think your employer is going to hang on for the long term on this? Weigh in the comments below. But let's shift to Philadelphia, where we get a slightly different picture, but overall the same story. Manufacturing activity in the region remained weak as the current general activity index rose, but remained negative. The new orders index turned positive while the shipments index remained negative and declined further. What's the difference between Philly and New York as the employment index rose from a near zero reading? Both prices index remained elevated as firms continue to expect growth over the next 6 months. I think those businesses in Philly are really thinking a fantasy is going to happen because what we know based on consumer expectations and their outlook is that what we're going to see over the next 6 months is the economy get a lot worse. And the evidence is very clear that this is not getting passed on through to consumers. As we look at the current prices paid for New York in blue and the current prices received for New York in red, we got that against the average weekly hours of production and non-supervisory employees in green. And you can see that average weekly hours don't follow prices paid. They follow prices received. And you can see very clearly that where incomes go, prices follow. And what are we seeing companies telling us? That hours worked are going to get cut. Philly actually raised them a little bit, but the problem is just a little bit. We have 4 or 5 other deals coming immediately, Trump said on May 9th. We have many deals coming down the line. Ultimately, we're just signing the rest of them in, but the problem is, my friends, that real damage to the economy may already be done. We already may be past the tipping point and heading into a recession. But just because the economy is looking bleak doesn't mean your trading account has to look that way. Let's check out that trade we put onto our Momentum Timer Pro subscribers for BITQ on April 30th. Stopped out yesterday for a massive 18.89% gain. And one of the biggest questions we get is, how do I know when to sell? Well, we let our stop losses do the talking. Now, how do we do this? Each and every day we run momentum screens across a broad equity, bond, currency, and commodity markets, but we pair it with the trend because when you come out of oversold condition and a downward trend, you tend to see price go down even more. But when you pair it with the trend, well, we've run this and back tested it, and that gets you our hot list called Momentum Timer Pro. Now, every day you get a list of hot trades, but in addition to that, you get all the momentum signals across all the sectors. We give you the daily 1 month, 3 month, and 6 month windows. You get the daily report, you get all the tradable signals. I review all of them, give you my opinion on the best trades to take. We give you risk control level, a full tracking of trades and returns, a weekly update, and here's the best part, you get a 30-day free trial. That's right, all you have to do is grab the links in the description below, use a coupon code for your free 30-day trial, and start trading momentum and winning big just like our subscribers. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.